Welcome to Investment Insights. Today I have Philip and Leah with me. Welcome both. Leah, we're almost at the end of the year. How are the funds performing?
Very well, Tatiana. Over the quarter, all the funds have returned positively, which have resulted in some very good performance over the past 12 months. This quarter, our funds benefited from strong performance in share markets. Economic data and company profits in the US have supported a rally in the developed markets, assisting strong performance and returns. This US strength also led to the New Zealand dollar dropping below 65 cents against the US dollar, which isn't helpful if you're travelling to the States, but it does help returns on any overseas assets which aren't hedged. Bonds and real assets weren't big drivers of returns this quarter. Rising interest rates in the US caused a simmer in the markets, resulting in a relatively flat return.
Philip, there's been a lot of attention in the media on the 10-year anniversary of the global financial crisis. When we look back, what are the key lessons and what does this mean for New Zealand investors?
There certainly has been. Of course, there's nothing the media like more than a good crisis, even if it was 10 years ago. Attracting far fewer headlines has been the fact that share markets have since had one of the longest and steadiest rises ever. This was initially started by the extraordinary policies introduced at the time of the crisis, and then since then as economic growth and company profits have grown strongly along with low inflation. You can read an article on the 10 lessons we think can be learned from the global financial crisis on the website, and some sound long-term principles for investing, which I'll talk about now. Firstly, diversification, which has been called the only free lunch in investment. Even if diversification hasn't paid off so much over the past few years, because pretty much everything has been going up, over most long periods, a diversified portfolio will achieve superior risk-adjusted returns as long as it's well constructed and there's a genuine diversification of risk and return sources. Secondly, as investors, we need to keep being dynamic. This simply means being ready for change because markets are always changing. And finally, active management will help in the environment ahead of us. Reduced volatility and a rising tide of liquidity lifting all boats has created a tough environment for active managers. But these conditions will change. Liquidity will become less supportive and markets will become more discriminating.
Thanks, Philip. Let's take a quick look at how each fund has performed over the last 10 years. Leah, while some share markets have been performing well this year, emerging markets haven't done as well. What are the emerging markets and do schemes members invest in them?
Emerging or developing markets are shares of companies from countries whose economies or financial markets are currently less developed than in countries such as the UK, US, Australia or New Zealand, but are changing, often quickly, and becoming more developed. As a result, they are expected to generate higher returns over the longer term for investors like you, though their share prices do tend to go up and down a lot more. Let's call it growing pain. So they are included as part of the growth assets of the fund, but with a smaller allocation compared to shares of developed markets like the US and Europe.
Philip, so what has been affecting emerging markets this year?
Well, this year has been a good example of how emerging markets can fluctuate more. There have been four main factors which have been affecting emerging markets this year. Firstly has been the strong US dollar, which has gone up because the US economy has been so strong. But the problem is this hurts the countries which borrow in US dollars, because they end up having to pay back more with higher interest. Secondly is trade protectionism. It's been headline news around the world and something we're very aware of here in New Zealand. And we've seen, for example, tariffs being imposed on Chinese exports by the United States. And emerging markets are very dependent on trade, so this can hurt them. Thirdly, there's the rising price of oil, which leaves us as consumers and businesses with less money to invest or spend on other things. And finally, in Turkey and a couple of other places, the political situation has scared investors and caused asset prices to fall heavily. We continue to believe, though, that emerging markets make sense to invest in for the longer term, and our specialist investment manager for emerging markets has done a good job in finding companies which have performed better than the markets overall.